$9,000. $9 trillion in US debt that doesn't exist as a headline because it's not new spending. It's old promises coming due. This is the refinancing wall, the moment the calendar turns into a weapon. While the news focused on election noise, celebrity trials, and the daily theater of inflation coming down, the real money was doing something else. It was repricing the cost of the United States staying solvent. A bond is supposed to be boring. A bond is supposed to be a promise with a date and a coupon, like a library book with late fees. You borrow, you pay interest, you return the principal. Done. But when the borrower is the global system's core, when the borrower is the United States, those promises aren't just paperwork. They're the floorboards beneath your mortgage rate, your credit card APR, your car loan, your rent, your job. The wall doesn't hit Wall Street first, it hits your monthly payments. And the cruel part is how quietly it arrives. Because the trap isn't that America owes trillions. The trap is that the debt has to be rolled again and again. The debt has to be rolled at whatever price the market demands. And the market has started to demand more. If you own a house, if you want to buy one, if you're renting, this is the shadow behind it. The refinancing wall is not a prediction, it's a schedule. And schedules don't negotiate. The United States doesn't pay off its debt the way you pay off a loan. It refinances it. Think of it like a massive household that never pays the mortgage down. It just resets the mortgage every time it comes due. That's fine when rates are low. It's fatal when rates snap higher. When bonds mature, Treasury must issue new bonds to get the cash to pay the old ones. That's rollovers. That's the wheel. The price of that rollover is the yield, the interest rate the market demands to lend. If yields rise, the cost of refinancing rises. That pushes the government's interest expense higher. Higher interest expense widens deficits. Wider deficits mean more issuance. More issuance means the market has to absorb more bonds. That loop is a pressure cooker. And it's happening inside plumbing most people never see. The repo market, primary dealers, and bank balance sheets. Repo is short for repurchase agreement. It's where institutions borrow cash overnight using treasuries as collateral. The oxygen line. When repo is calm, the system breathes. When repo tightens, even risk-free assets start acting like risks. Now layer in Basel III, bank capital rules. Banks used to be the natural sponge for government bonds. But under modern rules, banks can't always expand balance sheets. Their ability to warehouse risk is capped. So if the Treasury floods the market with bonds while banks are constrained, the marginal buyer becomes price-sensitive. Hedge funds, foreign sovereigns, pensions, asset managers. And marginal buyers don't buy out of patriotism. Duration risk is the quiet killer here. When you buy a long-term bond, you're locking in a fixed payment for decades. If inflation returns or rates rise, the value of that bond falls. Long bonds are basically a bet on stability. The refinancing wall is asking the market to bet on stability at the exact moment stability is the scarce commodity. So what happens when the market refuses to absorb bonds at the old price? The price drops. Yields rise. A contagion. Yields rising isn't just a line on a chart. Mortgage rates track yields. Corporate debt prices off treasuries. Treasuries are the gravity well. When gravity shifts, everything reorbits. This is why the Federal Reserve becomes the central character. The market controls the long end unless the Fed intervenes directly. That intervention has a name: yield curve control. It's a promise to overpower the market. In plain terms, it's the government telling the bond market, you'll accept this price. But that's not free. If you cap yields while inflation is alive, you risk currency debasement. The purchasing power of money falls. The Fed is trapped between two fires: let yields rise and break the economy, or cap yields and risk breaking the currency. Now the hardware of this trap is the auction. Every week the US Treasury sells bills, notes, and bonds. The real signal is the bid-to-cover ratio, the tail, the composition of demand. When demand weakens, Treasury must offer more. Why is this happening now? Because the world that made low yields possible is fading. Globalization, China, demographics, it's changing. To understand where this ends, we look at 1971. The US closed the gold window. Promises exceeded the metal. Gold was replaced by credibility. But every monetary order has a tell, the point where financing becomes the story. Today, the choice is harder. Back in the 70s, you could hike rates. Today, every percentage point hits a much larger base. The crash of 1929 wasn't just stocks. It was leverage unwinding. In a debt-based system, the true panic is not being able to roll the debt. Imagine 2026, not because of a villain, but because a calendar meets a yield. If yields stay high, mortgage rates stay high. Zombie companies start to fail. Defaults rise, layoffs rise, tax receipts fall. The loop tightens. In Financial Noir, the question is never, will there be a cost? The question is, who pays and who gets paid? If you hold liquidity, if you control cash flows, you can position differently. Prepare doesn't mean rich. It means not being forced. The refinancing wall is a machine that turns time into interest, and interest is a claim on your future labor. Empires don't fall only from invasion, they rot from financing. Rome debased coinage to fund obligations. Systems rhyme. Debt becomes the instrument. Inflation becomes the solvent. Trust becomes the collateral. Subscribe to see the pattern.